Silver just lost 5% in 5 days. It broke below $65 an ounce this morning. And the strange part, the part that should genuinely unsettle you if you're paying attention, is that this drop is happening at the exact moment a war just ended. Peace usually calms markets. This time it didn't calm silver at all. And the reason why might be the single most important thing you learn about this market all year. Let's start with where things actually stand today, Friday, June 19, 2026. Silver is trading around $64 and change per ounce, down more than 2% on the day, on pace for its worst week in over a month. Gold isn't doing much better. It's sitting near $4,200, down sharply from where it opened the week. And both of these moves are happening at the same time the United States and Iran formally signed a peace agreement in Switzerland this morning. Normally, a peace deal is the kind of headline that sends safe haven and inflation hedge assets either rallying on relief or selling off on reduced fear in a fairly predictable direction. This time, the metals market did something that confused a lot of people watching it. It sold off harder. Before we go any further, I want to ask you something. If you own silver right now, watching it fall while a war you'd been worried about for months just officially ended, would you know whether to feel relieved or worried? Be honest with yourself for a second. Most people watching this market this week don't actually know the answer. They just see red on the screen and assume the worst. By the end of this video, you're going to understand exactly why this is happening, and more importantly, what actually comes next. To understand today, you have to go back almost 5 months, to late January of this year, because that's where this entire story really begins. On January 29th, silver touched an all-time high of $121.63 an ounce. For context, that's a price level silver had never reached in its entire trading history. Not during the Hunt brothers' attempt to corner the market in 1980, not during the 2011 run that took silver near $50. This was uncharted territory. And it wasn't a random spike. Every condition that typically drives a precious metal higher was lined up at once, almost like dominoes stacked in a row waiting to fall in the right direction. The gold to silver ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold, had compressed all the way down to 50 to 1, a level not seen in well over a decade. When that ratio compresses that aggressively, it typically means silver is outperforming gold, often because investors are betting on silver's dual identity as both a monetary metal and an industrial one. Global investment demand for physical silver was surging. India's silver imports had jumped more than 30% in a single year, driven by both jewelry demand and a cultural shift toward silver as a store of value. Russia had formally added silver to its sovereign reserve framework, an unusual move for a metal that nations rarely stockpile the way they do gold. And on the industrial side, demand from solar panel manufacturing, electric vehicles, and electronics was running at a record pace. Every piece of the puzzle pointed in the same direction, up. Then, on February 28th, everything changed in a single day. The United States and Israel launched coordinated military strikes against Iran. Oil prices, which had been relatively calm, spiked past $100 a barrel almost overnight, and by March they had climbed above $130. That single geopolitical event reshaped the entire trajectory of the silver market. And here's the mechanism behind it, because this is the part most casual coverage glosses right over. Higher oil prices feed directly into inflation expectations, because energy costs ripple through nearly everything in an economy, from transportation to manufacturing to heating bills. Higher inflation expectations force a central bank into a more cautious, more hawkish posture, because the Fed's entire mandate is built around keeping prices stable. And a more hawkish central bank means higher interest rates, or at minimum, the serious and credible threat of them. Here's why that matters so much for silver specifically. Silver pays you nothing just for holding it. No interest, no dividend, no yield of any kind. Think of it like holding cash in a jar versus putting that same cash in a savings account paying you 4 or 5% a year. Every month you leave it in the jar instead, you're quietly losing out on what you could have earned elsewhere. That's the opportunity cost, and it applies to every single ounce of silver sitting in a vault or a portfolio. The higher interest rates climb, the more painful that opportunity cost becomes, and the more capital quietly drains out of metals and into yield-bearing alternatives like treasury bills. So silver fell. From $121 in late January, down into the 90s by the end of February, into the 80s by March, and down into the 60s by early June. By the time it bottomed near $63 on June 9th, silver had lost roughly half its entire value in just over 4 months. That is one of the fastest major drawdowns this metal has experienced in modern trading history, faster even than the crash following the 2011 peak. And here's the thing that I think gets lost in all of this. The cause wasn't a collapse in demand. It wasn't some flood of new mine supply hitting the market. It was almost entirely the result of one war, raising one number, oil, which fed into one fear, inflation, which forced one institution, the Federal Reserve, into a posture far more aggressive than anyone had priced in just months earlier. Now here's where the story gets genuinely interesting, because this is the part most people discussing silver this week are completely missing. On Wednesday, June 17th, the Federal Reserve held its policy meeting, and it was the very first meeting chaired by Kevin Warsh, who took over the Fed earlier this year, carrying a reputation as something of an inflation hardliner, someone with a long history of skepticism toward easy monetary policy. The Fed left interest rates unchanged at 3.5 to 3.75%, which was exactly what the market expected going in. But what came next caught almost everyone off guard. According to a Reuters poll of more than 100 economists conducted just 2 weeks before that meeting, the overwhelming majority, roughly 70 out of just over 100 surveyed, were expecting no rate change at all through the remainder of the year. Instead, reporting following the meeting described the Fed as signaling increasing support for interest rate hikes later in the year, a clear and meaningful shift away from the steady-as-she-goes expectation markets had been pricing. That single shift in tone moved markets harder than almost anything else that's happened this year. Two-year Treasury yields, which react fastest and most sensitively to Fed rate expectations, jumped meaningfully on the news. Equities wobbled, and gold and silver, which had actually been climbing earlier in the week on growing optimism that the Iran conflict was winding down, reversed hard almost immediately. Silver, which had touched nearly $71 on Tuesday as peace hopes built, fell back below $65 by Friday morning. Trading economics summed up the dynamic about as plainly as you'll find anywhere. Silver dropped because hawkish signals from the Federal Reserve outweighed the positive impact of the peace agreement. Let that sink in for a second, because it tells you almost everything you need to know about how this market is currently behaving. A war ending, something that should be unambiguously good news for a commodity that hates uncertainty and geopolitical risk, was completely overridden by a handful of sentences from a central banker about the future path of interest rates. That's the paradox sitting at the center of this market right now. Good news for peace. Bad news, at least in the very short term, for silver. Because the thing silver actually cares about isn't war or peace directly. Not really. What it cares about is the path of real interest rates. And this week, that path just got noticeably steeper. This is usually the point in a video like this where I'd ask you to subscribe, and I do want to ask, but only because of what's coming next, not as some empty, disconnected plug. If you're someone who actually wants to understand how these macro pieces connect to each other before the headlines catch up and explain it to you 3 weeks too late, that's exactly the kind of thing this channel is built around. Hit subscribe if that's genuinely useful to you, because the next part of this story is the part that actually matters most for what you decide to do with your own money. Here's the question almost nobody is asking out loud this week, and it's the one that actually unlocks the whole situation. If the war that caused this inflation scare is now formally over, why is the Federal Reserve still talking about hiking rates instead of cutting them? The answer comes down to timing, and it's a timing gap that almost nobody discussing silver right now seems to be accounting for properly. The inflation data the Fed is reacting to today still reflects the war, not the peace. The most recent full consumer price index reading available when Warsh spoke this week came in hot, still carrying the elevated oil prices from the conflict baked into transportation and energy costs. Warsh built his hawkish posture on that backward-looking number. But the peace deal that's now pushing oil back down toward $80 a barrel, as several market reports this week have noted, only became real in the last several days. It typically takes somewhere in the range of 4 to 6 weeks for a meaningful drop in oil prices to fully work its way through the inflation data that actually drives Fed policy decisions. The June CPI report, the very first one capable of reflecting this post-deal reality, isn't scheduled to be published until the middle of July. So right now, today, the Fed is hawkish based on a war that has technically already ended. And the market is selling silver based on a Fed stance that may not even hold once the real, updated data finally catches up. This is the gap. This is where the actual risk lives right now, and it cuts in both directions, which is exactly why I want to be careful not to oversell either side of this story to you. Let's talk about the bullish case first, because the structural argument underneath silver hasn't actually gone anywhere, even with prices down sharply from January's peak. The Silver Institute has pointed to a multi-year run of consecutive annual market deficits, meaning the world has been consistently consuming more silver each year than is being mined and recycled combined. That kind of structural deficit doesn't just disappear because a central banker raises his eyebrows at a press conference. Industrial demand keeps climbing too, and this part deserves real attention because it's often overlooked in favor of the more exciting investment demand story. Global solar installations have continued growing at a rapid pace this year, even as manufacturers have found ways to use somewhat less silver per individual panel through improved cell designs. The net effect, though, is that total silver consumption from the solar industry alone is still rising, because the sheer volume of new installations is outpacing the per-unit efficiency gains. Add in steady demand from electric vehicles, where silver is used extensively in electrical contacts and circuitry, ongoing demand from traditional electronics, and a rapidly expanding build-out of AI-related data center infrastructure that requires enormous amounts of high-conductivity wiring, and you have a metal whose physical, real-world fundamentals simply don't care what Kevin Warsh says in a press conference. The gold-to-silver ratio reinforces part of this story too. Earlier this week, before Friday's slide, that ratio sat around 61 to 62 ounces of silver per ounce of gold, which is actually below the 50-year historical average of roughly 65 to 70. Historically, when that ratio sits below its long-run average and continues compressing further, it has often, though not always, coincided with stretches where silver outperforms gold on a relative basis. That's not a promise of anything, it's simply a pattern worth understanding, the kind of context that helps you interpret daily price swings instead of just reacting to them. Now let's give equal, honest weight to the bear case, because a one-sided view here would do you a disservice. If the June inflation data, when it finally lands in mid-July, comes in hotter than expected, even with lower oil prices factored into the calculation, because inflation has become embedded elsewhere in the economy, in services, in wages, in housing costs that have nothing to do with energy, then Kevin Warsh has every justification he needs to actually deliver a real hike, not just talk about one in a press conference. Some major banks have already pushed back their expectations for any Fed rate cut well into 2027 this year. If a hike does land later this year, real yields rise further still. The opportunity cost of holding non-yielding silver climbs right along with them, and there is simply no rule of physics or finance that says $64 has to be the floor. A move down toward the mid-50s is not something you can responsibly rule out if that particular scenario plays out over the coming months. But here's where the story becomes even more interesting, because there's a structural detail in how Warsh handled this week's meeting that explains far more about the current price action than the headline rate decision alone ever could. According to reporting on the meeting, Warsh didn't simply hold rates steady and casually mention hikes in passing. He also pulled back noticeably from giving clear forward guidance about the Fed's likely future path, the kind of language that normally helps markets anchor their expectations for what comes 3 or 6 months down the road. That's not an accident. Stripping out forward guidance is a deliberate move. It preserves his ability to pivot in either direction, hawkish or dovish, without ever appearing to contradict something he said previously. For traders trying to position themselves, that kind of deliberate ambiguity is genuinely uncomfortable, and discomfort in markets tends to push capital toward caution rather than risk. That helps explain why both silver and gold sold off this week, even as an actual real peace treaty was being signed on the other side of the world. It's also worth zooming out for a moment and putting today's silver price into a longer historical frame, because numbers in isolation can be deceiving. The silver to Dow ratio, which measures how many ounces of silver it takes to buy one share equivalent unit of the Dow Jones Industrial Average, sits today at a level that remains historically elevated compared to where it stood back in 1980, during the last truly extreme silver bull market. That gap doesn't mean silver is guaranteed to close it anytime soon. Ratios like this can persist for very long stretches without resolving. But it does illustrate something important, which is that even after this year's dramatic run to $121 and the subsequent crash back down to the mid-60s, silver still sits meaningfully below what some historical comparisons would consider a fully valued level relative to broader equity markets. Whether that gap ever closes, and on what timeline, depends almost entirely on the macro forces we've already discussed. So where does all of this actually leave someone trying to make sense of the situation, rather than just trading off whatever headline happens to be dominating the news on any given day? The most useful way to think about it is in terms of a window, roughly the next 4 to 6 weeks, stretching from today until the release of the June inflation data in mid-July. During that window, the market is essentially flying without its single most important instrument, The Fed's current tone is hawkish, but that tone is built on backward-looking data. The peace deal is real, and oil is genuinely falling as a direct result of it. But that relief hasn't yet shown up in the inflation numbers that actually drive policy decisions. Anyone telling you with complete confidence exactly which way silver breaks out of this window is guessing, plain and simple. And you should treat that kind of overconfidence as a warning sign, rather than a reason to trust them. What history does suggest, and I want to be careful with the word suggest here, not promise, is that these kinds of macro standoffs, where a hawkish central bank collides with a genuinely cooling underlying inflation trend, tend not to resolve gradually. When the data does eventually turn, when a CPI report finally shows that energy relief working its way fully through the system, markets have historically not drifted slowly and calmly back toward fair value. They've often moved in sharp, compressed bursts instead, the kind of sessions where a metal can move several dollars in a single day because positioning had built up heavily in one direction during the period of uncertainty that preceded it. And to be clear, that dynamic cuts both ways. If inflation stays sticky despite falling oil prices, the reaction in the other direction could be just as sharp and just as sudden. If you're someone holding silver that you bought well below today's price, say anywhere under $50 an ounce, you're still sitting on a substantial gain even after this pullback. And the structural case you originally bought into hasn't actually been disproven by any of this. It's simply been delayed by a war, and then complicated by an unexpectedly hawkish new Fed chair. The risk in front of you now is a further near-term drawdown if the inflation data disappoints. So thinking carefully about position sizing and your own personal risk tolerance matters more right now than it has in months. If you bought closer to the January peak, somewhere up near $90 or even $100 an ounce, the honest question worth asking yourself isn't whether the long-term structural case for silver is still intact. Based on the supply deficit data and the industrial demand trends we walked through earlier, it likely still is. The real question is whether you have both the financial capacity and the emotional patience to sit through a possible second leg down toward the mid-50s, if the Fed actually does follow through with a hike in September, without being forced into selling at the worst possible moment out of fear rather than strategy. And if you're watching all of this from the sidelines entirely, having not yet bought in, what you're looking at right now is what some analysts would describe as an asymmetric setup, not a guaranteed one, never a guaranteed one, but asymmetric in the sense that you have a structurally tight physical market sitting underneath all the noise, a peace deal that has genuinely lowered the energy input driving inflation expectations, and a Federal Reserve whose current hawkish stance is built on data that is actively in the process of becoming outdated. Whether that combination resolves bullishly for silver, or whether sticky service sector inflation keeps the Fed hawkish regardless of what oil does, is something nobody can tell you with certainty today, no matter how confidently they say it on camera. What you can do, practically speaking, is watch the same two things the market itself will be watching closely over the coming weeks. The June CPI report when it lands in mid-July, and whether Kevin Warsh's tone shifts at all once that fresh data is sitting in front of him. So let's bring this all back together because there's a lot of moving pieces here, and the most important threads are easy to lose inside the noise of daily price swings on a screen. Silver's collapse from its January high near $122 down to today's level near $64 was driven almost entirely by one chain reaction. A war pushed oil prices higher. Oil pushed inflation expectations higher. And inflation expectations pushed the Federal Reserve toward a far more hawkish posture than markets had priced in just months earlier. This week, that war formally ended with a signed peace agreement, which on paper should have been unambiguously good news for metals. Instead, silver fell even further, because the brand new Fed chair used his very first meeting in the role to signal that rate hikes remain firmly on the table, based on inflation data that simply hasn't caught up yet with the falling price of oil. That gap, between what the Fed is currently reacting to and what's actually unfolding in the real world right now, is the single most important thing to understand about this market over the next month and a half. The lesson here isn't that silver is broken, and it isn't that a rebound is guaranteed either. The real lesson is that in markets like this one, the headline dominating the day and the actual underlying mechanics quietly driving the price can completely diverge from each other. And the only way to tell the difference is to understand what data is genuinely new and forward-looking, versus what's simply repeating an old, already priced-in story with a fresh sense of urgency attached to it. So here's the question I want to leave you with. When the June inflation numbers finally land in a few weeks, and the world finds out whether falling oil prices actually cooled inflation the way this peace deal implied they would. Do you think Kevin Warsh pivots toward a more accommodating stance? Or do you think sticky inflation sitting elsewhere in the economy gives him the justification he needs to hike anyway, peace deal or not? I'd genuinely like to know where you land on that question, so drop your honest take in the comments below. I read every one of them, and disagreements like this are exactly what make for a useful, grounded discussion, instead of just another echo chamber repeating the same headline back at you. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk in.